Hey guys, hope hope y'all having a good day. Please like and subscribe. Today we're gonna be doing a review of my long-term dividend picks. So it's gonna be a full video on the framework to follow for long-term investments. Right here, this is the framework I followed. Looking at the macroeconomics, the GDP, the real GDP is greater than the potential GDP, showing a expansionary cycle. Monetary policy, prices are increasing due to the business cycle. Interest rates have lowered since December, showing expansionary policy. Fiscal policy with government spending, taxes, the tariffs in these countries affect our government spending. So there's a non-cyclical and a cyclical section. So non-cyclical correlates with certain businesses that perform better in downturns of revenue in a economy. So show y'all real quick, non-cyclical. These are these business cycles where these non-cyclical stocks perform best at, or when it comes to revenue, they perform best. They can perform, they have a history of performing better because of the need of that business, their product and service, product and or service. Non-cyclical is the theme, real estate and energy. These are the two sectors currently during this time in the economy. There's been what is called a shock, a event shock with oil. So I like the non-cyclical choices because of the foundation of the usefulness of these two companies' service. Realty Income has a market cap, a large market cap, so it could grow more, meaning that the dividends, it could increase in dividends potentially. Chevron is a market cap of a mega market cap, so it's the max market cap. Here you could see the business model plus the stock. So Realty Income at 63.75. This was about 2 days ago. This stock was at. And right here, a real estate partner to world's leading companies, full service, their services, real estate capital, which is their properties that they own, portfolio of over 15,500 properties in all 50 states and in some other countries. They pay a monthly dividend, 1994. So they've been in business for a good period of time. They are a member of the S&P 500. So those are the best companies, top 500 companies in the United States. Founded in 1969. So about 55 years of business. All right. Their financials here. First category is how the company makes money. So the net income here. You can see the net income increased. So right here, you can see it started. Let's say that, right, we're going to view as this is what the company started with. We're going to view as this is what the company started with. How did they utilize this resource here, right? How did they utilize this resource right here? So they were able to utilize an increase of 14% into 2023. And in 2024, they were able to get a larger percentage net income increase of 16%. So they increased by 1.3% into the following year. Into 2024, 2025, the net income decreased. It decreased in the growth rate, but it still continued to increase in net income. It's just that the growth rate of net income growth decreased. But now we can have that sentiment of perspective that it could maybe be 5.7% into the next year. But it's about the data, seeing the data of what is shown. The net profit margin here, so the profit per dollar has increased exponentially. 2022, it increased about 40 cents. That is the two aspects of the how the company makes money, how the company spends money. This is the second section. You can see the total expenses here. It did increase, but into 2025, it decreased in growth, which is good. It's good to see that. It's good to see actually that our percentage growth was the net income percentage growth increased greater than the total expenses percentage growth. Difference of net profit margin decreased. Can expect that when seeing the net profit margin here. If the net profit margin's increasing, then the difference of it is decreasing. So our cost per dollar now is less. The end cash position here, we can see that it increased 30% into 2024. So it's good to see that the the end cash position increased. alongside the net income, we had decreasing total expenses. For the third section of the financials, how the company invests and leverages the assets. You can see the assets increased by 7.8% into 2023. Into 2024, that asset growth increased greater than 2023. This is a good sign of asset growth. We can see here that the 20 into 2025, the asset growth was less than the total expenses, but that's okay. There was a great end cash position growth, and for the total expenses, about 2.5% covered 3 point. There was 2.5% compared to 3.4%. So total expenses 3.4%, and then end cash position 2.5%. Liabilities here increased into 2025. The liabilities were at its lowest percentage growth rate, so that's good. And for equity, the equity increased into 2024, continued increasing into 2024. So we can see here the equity grew by 1.3%. So equity grew less than liabilities. It's good that it was about 0.5%. The asset growth was about half of the liabilities almost. So that's good. The quick ratio here, you could see that their coverage of assets, so about 18 cents of assets, which is cash and cash equivalents. That is the equation of this. So at 18 cents of every dollar covers liabilities. So our ability to cover liabilities, current year liabilities, has decreased. It shows they could be using that cash and cash equivalents into the assets to increase equity or into capital investment for the net income. The earnings per share here, $1.17. This earnings per share is less than the Simon Property Group. The price to earnings ratio is greater than the real estate ETF price to earnings. So there's, I would say there's more buying of this type of stock. There's more buying of this stock. Salmon Property Group has a price to earnings ratio of 14.16. So this is the very low compared to the real estate ETF. It has a dividend of $2.20 for $200 a share. The advantage of Realty income is that it has a monthly dividend payment. See here the dividend track record is continue. They're what is called a dividend aristocrat, where they've consecutively paid increased their dividend payment for 25 plus years. They pay 27 cents per share, and with a $1,000 investment can make $48 a year. This is some company data about Realty income. Right here is the stock price. I purchased one right here, the shares owned. I've purchased 1.7. This is the fractional share. So I have one whole share. Current stock price is 63.81. This is the total gain, total investment. The average cost was at 62.86. Let's see here the locations of the industries, the locations of the buildings that are leased to the clients. Where we could see United Kingdom, Mideast, Southeast Europe. And these are the type of properties they have. Retail, retail in these countries, industrial in these countries, gaming and other. Other could be agricultural. Right here, I circled some companies that I felt had good demand, everyday good demand, like 7-Eleven, FedEx, BJ's, Home Depot, LA Fitness, Walmart, Sam's Club. The If you calculate the return of the dividend received, So let's say it's at 63.80. We do 0.004. So we get 25 cents. So it's about 4%. So we're getting 0.4% return per share. And this actually matches with the consumer price index. That is the average consumer price index inflation reading is about 0.4%. So that is how we are able to beat inflation. The second non-cyclical stock that I chose to look at, Chevron at $188 a share, the last time I'd seen it. They have energy and chemical operations in the United States and internationally. We will be able to see some company data of the international places that Chevron does business with. So they have a part of their business model where they do development, production, and transportation of crude oil and natural gas, processing that gas, processing liquids. They have they have renewable fuel. See with their financials, the first topic, how the company makes money, the net income. You can see it was decreasing. It was decreasing. You'll see by these orange marks here, these are some important factors. We'll see down here on this third topic, an important factor compared to these other topics. So the first segment of how that company makes money, you can see that the net income average average decline. So that decline of the net income slowed. So that's a good sign. This could show that they increased their spending elsewhere. So we'll see where they put that spending soon. The total, uh, the net profit margin, could see that the profit per dollar decreased. On to the second topic, how the company spends money. Total expenses had decreased. They decreased, increased slightly, and then decreased again. So into 2025, we have from 2025 into this year, we've decreased, the expenses have decreased. It is continuously, it's in a continuing down trend of total expenses decreasing. So that's a good sign because the costs were being managed while the net income was decreasing. So the difference in net profit margin, we can expect that the costs per dollar were great. Moving on to the end cash position, the that decline, that decline went from it decreased into 2023 30%, and it stopped decreasing at that rate. And it's now at 6.1%. So it could potentially expect a 6.1% decrease again, or it becomes positive. Moving on to the third topic, how the company invests and leverages. The assets increased. So it's the one thing I was thinking about that was good to see in the company, that with the assets went from it into 2023 increased by 7/10, but then we could see that from 2022 it continuously is on an uptrend into 2025. So the 2025 growth rate was 12.3%. And then we can also see that in the equity, that it continuously increased. So the assets and the equity grew while the net income was decreasing and the total expenses continued. So the total expenses on it is on a continuing downtrend. The assets and equity are in a continuing uptrend, and the net income is on a continuing downtrend. So it's good that they're covering their money through assets while their net income's declining. So they could be investing greatly into themselves. We'll see into the next years what the net income will be. See here with the valuations. We have a earnings per share of 6.64 compared to ExxonMobil to 6.70 earnings per share. So the net income aspect of ExxonMobil could be greater because of that earnings per share. That's because of the equation of earnings per share has to do with net income. The dividend for Chevron is $1.78 compared to Exxon's $1.07. The price to earnings ratio of Chevron is 28, while Exxon's is 22. So we could see that there is more money being paid for $1 of earnings, which could show could say there's more money being put in, there's more willingness, there's a higher demand in that price, which could be because of that dividend. So the dividend track record is 20 years. That's good. Sustainable dividend. And with this investment, $1,037 a year, do a thousand divided by the stock price times the dividend. Here, here we can see the Chevron's company data. Right here, these are a bunch of screenshots of the locations of where Chevron does business. It's about, let's see, let's say 5, 10, 15, about 20 different locations worldwide. About 20 to 30 different locations worldwide. See here their products and services, technology, driving the future of energy exploration, right? So you can think of the capital investment, right? How do they go about capital investment? Which is to grow the net income. And the way that they do capital investment could be with assets, right? The equity and assets increase, so could have been some capital investment into those assets and equity. See here, their renewable fuels, oil and natural gas, oils, fuel. This shows who they work with, how they go about their operations. So communities, regulatory agencies, industry groups. That is the that is the company analysis. Here I had marked the price levels to buy it. So Chevron's at a swing price here. It's at a swing price here. So 186.46. Realty income purchased around this area. So I could do average average cost around 60 to $64. I'll show you y'all how I went about marking these price levels, the swing high and low levels. Swing, there's a swing high right here. Swing high right there. Swing low right there. So these are all of our buying prices. We can choose where to average our price in. Of course, the lower the price, the better of your cost for dividend. Mark some buying levels here. I hope this educated you guys on how to choose and create a long-term dividend investment plan. I'll see you guys in the next video with day trading. Take care.